Hey folks, it's Jeremy Whaley here from Trade Maestro, and I want to talk to you today about one of my absolute favorite strategies. And I'm going to share with you how you can get paid for stock that you don't even own. Is that possible? And the answer is yes. And this is a bread and butter strategy. This is a strategy that I've been using for years. I know lots and lots of traders that have been using this for years. And it answers one of the two most important questions that I get all the time. There's two questions I get. I've been getting them for 15 years, ever since I started teaching trading. First question I get is, which stock should I buy? Of course, everybody wants to know which one's going to make them a lot of money, right? Second question I get is something like this. They'll say, I have $50,000 or I have $75,000. Can I actually replace my income with that? And whenever I get that question, of course, we have to talk about a couple things. You know, what kind of income do you need to replace? Blah, blah, blah. But one of the go-to strategies I'd use is this one right here that I'm going to teach you. So if you've got one of those trading accounts, it's like maybe $50 to $100, $150,000. It's not quite enough to just, set it and forget it and, let it gain 5% a year and you can retire on it, but it's enough you can do something with. This is an excellent strategy for you. And I'm going to show you right now what you can do. This is how you can get paid again for stocks you don't even own. Now, the tool we're going to use for this is the put option. And a lot of people are afraid of selling naked puts. A lot of people are afraid of selling options in general. But once you understand the function of this, you realize that not only is it safe, it's actually strategically much better than buying the stock. So let's set the stage. Let's say you've got a stock that you want to buy. And as an example, let's come over here to our charts and let's look at something like NVIDIA. NVIDIA has been a very hot stock lately. This is ticker symbol NVDA. They're all into AI and all that stuff. And you can see that this trade is, it's taken off. It's looking really good. We've been in a bullish trend. It's starting to break out again. This is a very common trade setup with your stochastics moving up where people would say, hey, I think I'm going to buy this stock. Now, the stock is currently trading at $191.49. We'll just say $191.50. We'll round it up for good measure here, okay? Now, let me ask you a question. If you wanted to buy this stock at $191.50 and you believe that this is a good trade and it's going to go higher, would it behoove you to buy it for less? I mean, it's kind of a no-brainer. The answer is yeah, absolutely. If you're willing to buy it at $191.50, I would certainly be willing to buy it at $185 or $190 or $187.50 or any of those options in there, right? Yeah, why? Because it's cheaper than the current price, and cheaper, if you're bullish on a stock, is usually better. So let me show you what we can do with a put option. Now, coming back to our slides over here, an option, in this case, a put option, is going to give the buyer the right but not the obligation to sell a stock at a specific price on or before a specific date. So the put option is the right to sell the stock. Now, coming back to our chart over here, let's say that you were to sell somebody else the right to sell you the stock at $185. So you are shorting a put option. You're selling someone else the right to sell you the stock. Well, what are the odds that they're going to sell you the stock? Well, if the stock goes higher, they're not going to sell you the stock. If the stock stays the same price, they're not going to sell it to you for $185. And if the stock comes down, then they're going to sell it to you for $185. But guess what? You were already willing to buy it for $191.50. This is literally $6.50 cheaper than you were willing to buy it for. So would you be upset? I would hope you would not be upset because, as I just said, it's $6.50 cheaper than you were willing to buy it for. But it doesn't stop there. It goes a step further, and I want to explain that to you right here. Whenever you sell this option, there's a couple things that happen. Number one, you put the probabilities on your side. I just drew it out for you. If you buy the stock, you have a 33% chance that this trade's going to go up. You also have a 33% chance that the trade's going to stay the same size, same direction, same price, I should say, or it's going to go down in value. That means you have a 66% chance, just raw statistics, you have a 66% chance that this trade is going to go against you. If you sell the put option, you flip that. If you sell the put option, you still have the 33% chance that it's going to go up. You still have a 33% chance that it's going to go sideways. And in both of those cases, you collect the premium and do nothing. But you also have that same 33% chance that it's going to go down. You might get put the stock, but are you going to complain? No, it's $6.50 cheaper than you were already willing to buy it for. But here's the big difference. The big difference is you get paid up front to do that. You get paid to take that risk. Instead of going out and spending $191.50 a share to buy 100 shares of NVIDIA, which is fine. I don't care if you do that. That's fine to go do. But instead of that, what if somebody would pay you up front, like right now, cash in your trading account? You say, well, how much would somebody do that for me? Would they really do it? Yeah, they would. Let me show you. All right, so here's what we're gonna do. We're gonna come over here to our options chain, and I happen to have NVIDIA pulled up here. And this is only 10 days out, okay? And we used, what did we say, 185? So you actually could receive right now, with just 10 days out, you could receive about $3.40 a share. Now, here's your options, okay? Literally, your choices, your options. You could spend right now $191.50, and you have a 33% chance that the trade goes up, 33% chance that it stays the same price, 33% chance that it goes down. Or you could receive $340 per contract, $3.40 per share right now, and you have the exact same odds. The difference is you cash the $340 immediately. Now, what can you do with that? Well, if you did that trade, if you got the $340 up front, if you sold the naked put, you're obligated to buy it, okay, but you were going to buy it anyway, so it's not a big deal. But here's what you've done. You've now lowered the price that you're going to buy the stock. Instead of spending $191.50, if you do end up buying the stock, you only spend $185. So it's $6.50 better. But in addition to that, you collected $3.40 up front per share. So that lowered your cost basis even further. So instead of having a cost basis of $191.50, which is what you were willing to take on, here's what you end up with. You end up with a cost basis, let's go $185 minus the $3.40. So you're down to $181.60. What? You were willing to buy the trade at $191.50, and by doing this one maneuver, you lower your cost basis to $181.60. It's almost $10 a share less than you were willing to spend. I don't know why anybody would ever buy a stock any other way. Why would anybody want to just go spend their money and pay $191.50 a share when you could get paid up front? You could collect that premium up front, and you may be scot-free. You may never have to buy the stock, and you still collect the premium. Or if you do end up buying it, you end up buying it with a cost basis that is substantially less. I don't know why anybody wouldn't want to do that. It just makes sense to me. So let's put it on a bumper sticker right here. Why would you want to sell naked puts? Number one, you get paid up front. Number two, you increase your probabilities. You go from a 33% chance probability to 66. Number three, you make money in a sideways market. Even if the trade goes nowhere, you still get paid. Number four, you create predictable income. That's the big one right there, predictable income. And number five, you lower your cost basis. This is such a great strategy. It's such a great technique, and it forms the foundation of a new course that I'm teaching at Trade Maestro called the Retirement Wheel. And whenever I talk to people who say, hey, I have $100,000, I want to create steady income with this without lots and lots of work, but it needs to be consistent because I got to replace an income. This is where I go. It's one of the one or two strategies that I take them straight to, where we sell the naked put, and then we get into the stock position, and then we sell the call option, and we're constantly selling, bringing in money. A lot of people don't realize that you only make money in the stock market when you sell. When you buy, you're spending money. If you want money coming in, you got to be selling. And that's what we're going to be doing. Whenever we sell the put options, and then we sell the stock and we sell the call options, we are constantly selling, so money's constantly coming in. And I've laid it all out in this new course called the retirement wheel. I would love for you to take advantage of that. You can check it out over at trademaestro.com. Trademaestro.com. I've put the link down here below and in the comments. And listen, if you haven't done so already, you should like and subscribe to this channel because I got a lot more of this stuff that I'm sharing with you, and I want to make sure you don't miss any of it. So like and subscribe if you haven't done so already. I thank you for watching. I hope you have a wonderful day. And until next time, happy trading to all of you. We'll talk to you soon.